I am going to save you from losing money right now in the next 10 minutes. Because the mistakes I am about to show you are not theoretical, they are happening to real investors right now in 2026, and most of them will never figure out what went wrong. I have studied hundreds of investor stories, talked to financial professionals, and analyzed the data on why most retail investors underperform the market year after year. And every single time it comes back to the same 5 mistakes. Not bad luck, not bad timing. The same 5 psychological and strategic errors that destroy portfolios before they ever have a chance to grow. If you are new to investing, this video could literally be worth more to you than any stock tip I could ever give you. Because avoiding these mistakes is worth more than finding the next Nvidia. If you are serious about building real wealth and not just gambling with your savings, hit that subscribe button right now. This is the foundation that everything else is built on. Here is what we are covering. 5 mistakes that are destroying beginner portfolios in 2026. Each one is backed by real data. Each one has a clear solution. And at least 2 of them are going to make you uncomfortable because you are probably doing them right now. Let's get into it. Mistake number 1. Panic selling, and it is destroying more portfolios in 2026 than any other single mistake. Here is what happens. You invest in a stock. The market drops. Fear sets in. You sell to cut your losses, and then you watch that same investment recover and go higher than where you bought it. Sound familiar? One of the biggest mistakes beginners make is panicking and selling when the market drops. Selling in a panic often locks in losses that might have been temporary. While it is normal to feel uneasy when markets are volatile, investing is a long-term game. Here is the data that should change how you think about this forever. Fidelity carried out a study that looked at the best-performing portfolios across their entire business. The results were extraordinary. The best returns were achieved by 2 groups of clients: people who had died and people who had forgotten they had invested. They had invested in good assets and left them alone. They had not panicked and sold during market drops. They had not checked their portfolios every day. Read that again. The best investors were the ones who forgot they were investing. That is not a coincidence. That is a lesson. Here is the reframe. A stock dropping 20% is not a loss unless you sell. It is a paper number. The only question that matters is whether the underlying business is still intact. If it is, the drop is irrelevant. Here is my solution. Before you buy any stock, write down 1 sentence explaining why you own it. When the stock drops, read that sentence. If the reason still holds, do not touch it. Here is the painful truth. The most common mistakes beginners make are panic selling when the market falls and investing when the market is at its peak. Smart investors do the opposite. The market will always feel scary when it drops. That feeling never goes away. The investors who build wealth are not the ones who feel no fear. They are the ones who have a process that overrides the fear. Now let's talk about the mistake that feels like intelligence but destroys more wealth than panic selling. Mistake number 2. Trying to time the market. Every beginner does this. They watch the market go up and think it is too expensive to buy. They watch it go down and think it is going lower, so they wait. And then they watch it go up again without them. Trying to predict market highs and lows often leads to buying at high prices and selling at low prices. Consistent investing works better than timing the market every single time. Here is the data that makes this undeniable. If you invested $1,000 in the S&P 500 in January 2010 and never touched it, you would have over $7,000 today. If you missed just the 10 best trading days over that entire period by trying to time the market, your return drops by more than half. 10 days out of thousands of trading days, and missing those 10 days cuts your return in half. Historically, valuations like PE ratios have not been reliable signals for telling investors when to get in or out of the market. Markets have historically delivered more modest positive returns after periods of high valuations, but still better returns than are typically available in bonds or short-term investments. High valuations on their own should not be a reason for selling out of stocks or avoiding investing. Here is the reframe. Timing the market is not a skill. It is a trap that feels like a skill. The investors who consistently try to time the market consistently underperform the investors who just stay invested. Here is the solution. Dollar cost averaging. Invest a fixed amount every single month, regardless of what the market is doing. When prices are high, you buy less. When prices are low, you buy more. Over time, your average cost per share is lower than if you had tried to time every entry. It is boring, it is mechanical, and it works better than almost anything else in investing. Drop a comment right now. Have you ever sold a stock in a panic and then watched it recover? I want to hear the story. Let's keep going. Mistake number 3. Following social media stock tips. This one is uniquely dangerous in 2026 because the amount of financial content on social media has never been higher and the quality has never been lower. One of the biggest mistakes new investors make is jumping into the market without any knowledge. They often invest because a friend suggested something or because they saw a trending video recommending a stock. Investing blindly is extremely risky. A lack of knowledge leads to emotional decisions, panic selling, impulsive buying, and inconsistent investing. Here is what is actually happening on social media. Content creators get paid for views. Views come from excitement. Excitement comes from recommending stocks that have already gone up dramatically. By the time a stock is trending on social media, the easy money is usually already gone. And the people who bought it early are often looking for someone to sell it to. A lot of investors make the mistake of chasing trends or what is cool because of FOMO. Experts recommend always doing your due diligence before putting your money in the market. Here is the data point that should terrify every beginner. Studies show that stocks featured in viral social media posts significantly underperform the market in the 12 months following the peak of social media attention. The attention itself is often the top signal. Here is the reframe. Social media shows you what already happened. Serious investing is about understanding what is going to happen. Those are completely different skills. Here is my solution. Before buying any stock you saw on social media, ask one question. Do I understand this business well enough to explain in 2 sentences why it will be worth more in 3 years? If the answer is no, do not buy it. Here is the uncomfortable truth. Most of the content you are watching right now, including channels that are very popular, is optimized for engagement and not for your financial success. The creator gets paid whether you make money or lose money. You need to know that going in. Mistake number 4. Not diversifying. And in 2026, this mistake has a specific new flavor that most beginners are falling into. Diversification is a fundamental principle of investing. It helps reduce risk because different types of investments do not all move in the same direction at the same time. If one stock or sector is struggling, other parts of your portfolio can help balance out the losses. Here is the 2026 version of this mistake. Most beginner portfolios right now are overloaded with AI stocks. Nvidia, Broadcom, Palantir, Meta, Microsoft, all AI, all technology, all moving together. That is not a diversified portfolio. That is a concentrated bet on one theme. And when AI sentiment shifts, and it will shift at some point, all of those positions will drop at the same time. Even diversified portfolios can fail when investors own too many similar stocks, invest only in one industry, ignore international exposure, or rebalance too frequently or not at all. Diversification works best when applied thoughtfully. Here is the data that makes diversification non-negotiable. During the 2022 market sell-off, technology stocks dropped an average of 45%. Investors who held only tech stocks saw their portfolios cut nearly in half. Investors with diversified portfolios including energy, healthcare and consumer staples saw drops of only 15 to 20%. Same market. Completely different outcomes. The only difference was diversification. Here is the solution. A simple diversified portfolio for a beginner looks like this. 60% broad market index funds covering hundreds of companies across all sectors. 20% international stocks, giving you exposure outside the United States. 10% bonds, providing stability when stocks fall. And 10% individual stocks in areas where you have genuine conviction and understanding. That allocation will not make you the best performing investor in a bull market, but it will keep you in the game when the market turns. If you are finding value in this breakdown, hit that like button right now. This content takes serious research to put together, and your support helps reach more investors who need to hear it. Let's get to the last mistake. Mistake number 5, starting too late. Or more specifically, waiting until you think you know enough to start. This is the mistake most people never even recognize as a mistake because it feels responsible. It feels like you are being careful and doing the right thing. The point in life when we have the most time ahead of us coincides perfectly with the time when we have the least money. Time is wasted on the young when it comes to investing. The best performing portfolios belong to investors who left their money invested for long periods without making changes. Here is the math that makes this the most expensive mistake on this list. $1,000 invested at age 25 grows to over $21,000 by age 65 at a 7% average annual return. The same $1,000 invested at age 35 grows to only $10,000 by age 65. Same money, same return, 10 years difference, more than double the outcome. The most important rule in investing is not timing the market, but spending time in the market. The earlier you start, the more you benefit from compounding. You do not need a large amount to begin, you just need the right knowledge, the right strategy, and patience. Here is the painful truth about waiting until you know enough. You will never know enough. The market is infinitely complex. Professional investors with decades of experience and research teams of hundreds of people consistently fail to beat a simple index fund. You are not going to reach a level of knowledge where investing becomes safe and certain. That level does not exist. What you can do is start small, stay diversified, invest consistently, and let time do the work. That is the entire strategy. It is not complicated. It is just uncomfortable because it requires patience in a world that rewards speed. Here is the solution. Start today. Not when you feel ready, not when the market looks better. Today, even if it is $50 a month into a broad market index fund. The habit of investing is worth more than the amount you invest when you start. Let me bring this all together. 5 mistakes that are destroying beginner portfolios in 2026, and 5 solutions that cost nothing to implement. Number 1. Panic selling. The solution is writing down why you own every stock before you buy it. When it drops, read that reason. If it still holds, do not sell. Number 2. Trying to time the market. The solution is dollar cost averaging. Same amount every month, regardless of what the market is doing. Number 3. Following social media tips. The solution is one simple question. Can you explain in 2 sentences why this business will be worth more in 3 years? If not, do not buy it. Number 4. Not diversifying. The solution is a simple allocation across index funds, international stocks, bonds, and a small position in individual stocks where you have genuine understanding. Number 5. Starting too late. The solution is starting today, whatever amount you can afford, immediately. Here is the investing truth I want to leave you with today. Smart investing is not about chasing trends or reacting to every market swing. It is about staying focused, making thoughtful decisions, and building consistent habits. In a time when information and misinformation is everywhere, keep your strategy simple and grounded. Dividend investor. The investors who build real wealth are not the ones who find the best stocks. They are the ones who avoid the worst mistakes. You now know what those mistakes are, and you know exactly how to avoid them. That is worth more than any stock tip I could ever give you. Disagree with anything I said? Tell me in the comments. Which mistake have you made personally? I want to hear it, because that conversation helps every investor watching this video. Subscribe for weekly research on how to invest smarter, not harder. No sponsors, no fluff, just the analysis. See you in the next one.